Right, let's begin with question 1. We know that the fundamental corporate finance identity, which is MVA equals MBE plus MBD, is based on the determination of the present value of the cash flows attributable to each of those components of the equation. And we also know that the market values are not obtained from the accounting balance sheet, in this case prepared under IFRS. So this question, which gives you information about the book value of assets and the book value of liabilities at 10 million and 3 million rand, are not useful to us in determining the market value of the company. So the answer for question 1 is C. We do not know based on the information supplied to us. In question 2, we are asked what corporate finance is, and that answer for option A, how a business manages its financial resources, is in fact the very first sentence of the reading that you are going to be examined on in this course. The options B and C are problematic. B is too limited because that just looks at the financing decision, and corporate finance obviously also looks at the investment decision. And option C is problematic because just because an entity is in the informal sector does not mean that we lose interest in it. It is definitely part of the private sector, and the principles discussed in this course apply equally to a business in the informal sector. Question 3, the corporate component that is least likely, and I try to put a little bit of emphasis into my reading of the words least likely because they are problematic under exam conditions, where as you are hopefully going through the exam with growing confidence that you can do this and that you're doing well, there is the risk of overconfidence bias, and that you might just rush through these questions thinking that you're looking at the usual most likely situation. I recommend to all of my classes that you begin the exam by going through the whole paper, and whatever you use, a highlighter or a red pen or whatever it may be, just mark those least likely questions. They're in a 25 question exam such as this, they're likely to be 5, 6, maybe a little bit fewer, maybe a little bit more of these questions. Just do not let yourself be caught out by those. So we're looking here with the least likely question at a situation in which we know that there are going to be 2 correct answers and 1 false choice, 1 wrong answer, and it's the wrong answer that gets you the point for this particular question. You've got to identify which of these 3 choices, A, B, or C, is just wrong. The other 2 will be right, and in selecting the wrong one, you get the point. So we are asked about the firm's capital structure. So we are, of course, looking at the right-hand side of the corporate finance identity, and we know that on that right-hand side, we have equity and debt. Equity, we know, another name for that is net assets. Bank borrowing is debt. So this hopefully, as a kind of a check, a fail-safe, by this stage you should be pulling up short. If you haven't taken my advice and marked up those least likely questions, as you go through A and B, you may well say, but hang on a minute, there are 2 correct answers here. There's net assets, which is equity, and bank borrowing, which is debt. And both of those are part of the firm's capital structure. What's going on? And then you would hopefully rewind, and as a fail-safe, you would see this is a least likely question. So presumably I'm going to now read on and see that C is wrong. And indeed, we read on and we see that C is property, and that is an asset, and that is on the left-hand side of the identity. That is part of the assets of the firm, not its capital structure. So the least likely point here is, for 3, is choice C. Question 4, a company has borrowed money from investors. Which of these statements is most accurate? Now we're talking here about the business has borrowed money from investors. So clearly we are talking here not about ownership interest, but about debt. So for option A, the investors own part of the company, that's wrong, because just because you lend money to a company doesn't mean that you become part of its ownership structures. That remains for the shareholders of the company, not its bond or debt holders. B, the company has debt in its capital structure. Now, we're very happy with that. We say that that seems to be the right answer, but just to be certain, and there are only 3 choices to scan through in each of these questions, so we're going to look at C, and we will look at C and see if C is correct. And C, this, yeah, you know, an examiner who puts this in, and I'm the examiner in question, it's a test here to distinguish between those who are well rested, who didn't foolishly spend the night before the exam cramming away in the false belief that a course like this can be crammed for one night before or 2 nights before and then nailed on the day. C is for a well-rested, well-practiced, and well-prepared student who looks at C and says, that is absolute nonsense, because the investors have lent money to the company. The company has borrowed money from them, and the investors, to say that the investors will repay all the money plus interest is clearly a situation in which the cash flows are going in exactly the wrong direction. So A is wrong because debt holders are not owners. That's why A is wrong. C is wrong because the cash flows are going completely in the wrong direction, and leaving us to confirm that B we were initially happy with, and now we confirm it's the only correct answer. Question 5, another least likely question. By this stage, hopefully we have embedded the lesson to be learned here, that these are things to be careful about, and we are therefore going to be expecting to see amongst the A, B, and C 2 right answers and 1 wrong answer, and it's the wrong answer that is going to get us the point for this question. So the financial manager's responsibility is least likely to be to maximize. Now, we know that the objective function of the firm is maximization of MVE, the market value of equity, and we in this course also accept that the maximization of the value of the firm as a whole is an equivalent for our purposes objective function. So either MVE maximization or MVA maximization is what we're looking for here. So let's go through A, B, and C, remembering we're looking for 2 right and 1 wrong. 5A, the required rate of return on the company's shares. We should just stop there. Even if we are a little bit confused by that, we should just be cautious, because we remember that MVE maximization of the equity value, is the same thing as maximizing the share price. But that is not saying the share price is to be maximized. It's saying something else. Let's come back to A. Let's turn to B. Aha, there we go. There is the company's share price, and that is the maximization objective, the purest determination and expression of the corporate finance objective function. Maximize your company's share price. And C is the version of that objective function that I referred to briefly earlier, that it is, for our purposes, equally acceptable to look at maximizing the total market value of the company. So B and C look right to us, and therefore our concern about A seems to be justified. But what is wrong about that? I think there's an interesting learning opportunity in there, and that links to our understanding of the inverse relationship between the discount rate, in this case referred to as the required rate of return, but that is exactly the same from an investor's perspective as our cost of equity. And the higher the cost of equity, or in this case rate of return on our shares or our equity, the lower our share price. So 5A is wrong, because if you try to maximize that rate of return, you are, because you understand that inverse relationship from coming from the principles of time value of money, that the higher the discount rate, the lower the market value. So A is wrong, and we then choose A for question 5 to get the point. And that concludes the first 5 questions of this mock exam. Thank you very much, and I'll see you in the next one.